Brilliant Minds in Real Estate is a podcast series that brings illuminating interviews with today's most relevant and motivating leaders throughout all corners of the real estate investment sector. I'm your host, Suraj Nambiar. My special guest is Samir Kazi, Head of Strategy and Investments at AW Rostamani, a multi-billion-dollar UAE family-owned business with interests spanning a broad spectrum of automotive, real estate, lifestyle, logistics, travel, consultancy, and investment businesses. Its flagship subsidiary, Arabian Automobiles Co., is the exclusive distributor for Nissan, Infiniti, and Renault in Dubai and the Northern Emirates. Operating 21 showrooms and 16 service centers, AWR's real estate business began in 1982 and today builds, owns, and manages assets across residential, commercial, retail, and logistics. Samir brings over 20 years of experience in investments, portfolio management, and development management, having worked with Dubai World, a sovereign wealth fund, SEDCO Holding, a prominent Middle Eastern family office, consulting firms such as Deloitte and Arthur Anderson, and even worked on hotel operations with the Radisson and the Holiday Inn. I've had the pleasure of knowing Samir for a few years now, and he's known for his uncanny ability to sense check deals and to properly price risk regardless of the asset class and the market. Samir, I'm delighted to have you on the podcast.
Thanks, Suraj. Happy to join the chat.
Samir, you've got an MBA from Warwick Business School in the UK in 1998, but before that you studied hotel management. Talk to us a little bit about the thought process when finishing school and how you made a career in the real estate game.
As most of us, when we start our school, we kind of identify areas that interest us, and hotels quite attracted me during my school and university days. So I pursued a program in hotel management. Fortunately for me, after graduating from hotel school, the first job that I got in the hotel industry, or the first couple of jobs that I did in the industry, were in the regional and corporate offices of the hotel chains, rather than in the operations of a hotel per se. So what that did for me is I looked at the hotel industry or the hotel asset as a business rather than as an operation. So that helped me kind of give me a wider vision and open my mind in the very early stage of my career. So after gaining a few years experience at the regional and corporate offices, I thought an MBA was warranted to kind of supplement the little experience I had. And so basically I took that step from moving from hotel operation management into kind of looking at the broader business side following the MBA. So yes, I think the break of starting with regional offices really helped, because typically once you start into hotel operations, it takes a while longer to kind of step out and look at it from a broader perspective.
Samir, what I love about your work experience is that you sat on all sides of the table. Hotel operations, as you just mentioned, with blue chip consultants. You've also worked with Middle Eastern sovereign wealth funds and then more institutional asset managers. What role do you think you enjoyed the most, apart from your current one at AW Rostamani?
I've enjoyed every aspect of experience I've had, and I think the variety of work I did actually built up and culminated, what my performance depends on today. So operations helped. You really understand. You look at how the consumer comes in, how your staff and peer work, and how the consumer gets processed, why they pay, what they pay. So that was the early part of my career. Then as I progressed into consulting, I started looking at it from a return perspective, feasibility perspective, asset management perspective. So what the owners were looking for, what the debt equity ratio should be, what are acceptable levels of return, what are the risks in the businesses. So that helped me quite a lot. Going into sovereign wealth fund stage was a complete different level where suddenly the ticket sizes jump up. But at the end of the day, the business dynamics and the risks reward and the performances kind of remain similar, whatever the size of the business, but just the business is on a different scale. And then I evolved into getting into asset management. So at every stage, whether it was operations, then looking at the capital side of the market, then getting into, say, asset management due diligence, where you look at a lot at the structures, whether it's tax, legal, or funding. So all these variety of experiences, each one of them were fantastic, and they really helped me put together a kind of a wider experience. So I wouldn't really pick any one in particular.
Could you give us an overview about the group's real estate business and shed light on some of the last few transactions that you've closed?
So the AW Rostamani Group, the two strong pillars of the group are the automotive business and the real estate business. And the automotive business, given that it's a known public brand, Nissan, Infiniti, and Renault, it's a more visible side of the business. Whereas the real estate, except for the few buildings where you see the AWR logo, people are not well aware of the diverse portfolio that the family owns. The family has a very well diversified business within UAE. And when the second generation stepped in, they looked more focused on going overseas. So from a portfolio perspectives and recent transactions, the focuses has been more on going in the Western markets, in the developed markets to acquire assets. So recent transactions we've done include in Europe, office buildings. We're looking at student accommodation. We're looking at a portfolio of logistics warehouses. So the typical family office investments that are done in developed market, the AWR group is looking to do those and are doing those in the market. More on the local front, recently last month, the group opened its first investment in the hotel. So we opened a DoubleTree in Mankul. The family does not support alcohol revenue. That's why hotel was never kind of a key allocation within the portfolio. But now we have our first investment in the hotel industry. It's given us very good feedback. We may look to do more. So the family is quite active within UAE, but a large focus is on diversifying the portfolio geographically, which is going towards the developed market.
Samir, you mentioned that AWR has, in the recent years, starting in increasingly investing in Western markets. As a leading private family office that has a substantial footprint across business lines in the Middle East, what's your view and strategy on UAE investments versus international real estate investments? And can you talk about some of the main deal metrics that UAE-based private family offices such as yourselves seek in markets such as the US, UK, and Europe?
So let me approach the first question you had about, the deal metrics people would look at for UAE versus international. So UAE is a home ground for us. So what we look to do is we look to acquire existing assets, but we are willing to purchase land bank, build on our land bank, and also look to develop on our land bank. So we are happy to take a higher level of risk in our home ground because development can be challenging at times. So if we are on the ground, we can have a better hold on it, we can control it better. So the metrics locally is focused more on IRR and total return versus the metrics for going geographically outside of UAE focuses more on income rather than IRR. So in markets outside, we don't look to take development risk. We try to look for stabilized income in stable markets with a good quality asset. So the difference I would say is UAE, we kind of lean towards being yield plus IRR, so a total return perspective, whereas for overseas market, we are more focused on yield rather than total return.
Samir, so historically, Middle Eastern investors have invested exclusively in blue chip offices in central London or say New York. I'm talking about back 15, 20 years ago, or perhaps even as recent as 10 years ago. Today, I think the story is quite different in that Middle Eastern investors are not only looking at secondary locations in the Western markets, but also at emerging asset classes such as student housing, senior living, and data centers. Do you believe that the shift is purely a hunt for higher, more diversified yields? Or do you think that this is a factor of Middle Eastern investors and asset managers becoming more mature and willing to venture out of their core comfort zone to derive value?
I think it would be a combination of a few factors. So the early investors, let's say 15, 20 years ago, most of the capital that went overseas were large ticket institutional investors, namely the sovereign wealth funds. It's only during the last, say, 10, 15 years that family offices have become a sizable direct investors in the market overseas. So one, the central, let's say any central trophy property, the ticket sizes are high. So only certain institutions can kind of go into them. And the way the yields have been in the last 5, 10 years, the yields on these, let's call it trophy location or trophy assets, have been very low, and investors have mostly relied on the capital growth for these markets. As the other pockets of capital started coming in, there was a requirement for a higher yield and hence people, and a smaller ticket size, or let's say a medium sized ticket size. So that was not possible in the central areas in abundance. So people had to go to the periphery. So it not only gave you yield, but it also, one could, buy an asset to meet your requirement of ticket size. So that was one part kind of that drove. The other part of it was there are a lot of now GCC based investment or asset managers who are looking to do business. So they obviously have a level of revenue to be made. So if you're going to say central trophy location, the yields are so less. So the asset manager cannot add a lot of value or make economics out of those transactions in a meaningful way. So going out, what it does is it gets higher returns for the investors, and the asset manager is able to demonstrate and justify the value that they add for these assets. So I think it's working out as a balance. It works out quite well. And at the end of the day, depending on the source of capital and the requirement of the capital, people still continue to go to central trophy locations, and there are other allocations which go more to the periphery. So it really boils down to the risk return requirement of the capital.
On that note, could you suggest, or what in your opinion would be the most exciting asset classes to invest in the next 12 to 24 months within those Western markets?
So right now, a lot of capital is chasing logistics, and what's happening on the contra is retail, which was anyway slowing down, is kind of, I wouldn't say dying, but it's not getting any more traction. So COVID has made that significant change of making logistics a very attractive asset class, and retail kind of dying. But if one were to look outside of that, let's call it the accommodation sector, whether it's the residential or student accommodation or serviced apartments or hotels, they are slowly becoming attractive. Hotels currently may be struggling because there's not a lot of global travel happening, but hotels bounce back quite fast in terms of occupancy, average rate lags. So if there is an opportunistic investor, hotel could be a attractive opportunity to go in, because whether you look in US or outside, a lot of these CMBS or hotel investments have a lot of mezzanine layer sitting on top. So people who are not able to service their debt, whether mezzanine or senior, they would be in a distressed position to sell. So an opportunity today would be, you look at an asset which is tired, a hotel asset which is tired, where not a lot of money is spent on renovation. You take it on your books, you spend the next, say, 6 to 12 months on renovation of the asset at a time the market is very slow. Once the renovation is done, you see whether the operator needs to be changed, you get a new flag on the property, and as the market is bouncing back, you kind of go in. So your going in basis is low, your downtime for the asset is when the market is not very great. And as the market is looking to bounce back, you kind of repositioned your asset to benefit from that. So I would see hotel as a very strong opportunity. But other than that, the bed sector, whether it's residential, student accommodation, or any other form of that, would be quite attractive. And logistics remains the star right now.
That's fascinating. You're right in that there's so much capital moving into the logistics space. Some may argue that the space is quite overheated, while others continue to talk about how the market's going to grow and the advent of e-commerce is going to outweigh any risks of overheating. There are certain places, for example, in Germany, where yields have compressed substantially, while secondary cities in the US still can give you, anywhere between 8 to 9% cash on cash. Where do you feel is the sweet spot, and what sort of strategy would you put in place for logistics overseas?
I think logistics, the view that the investors have, despite dropping yields, and the reason why a lot of capital is chasing is because people are seeing the evolution or the acceleration of the economy going digital. So because of that, whether last mile logistics or hub logistics, they would grow over the next coming 5-10 years. So although the yields for investors, the yields may find low right now, but they believe this is sustainable and there is going to be capital growth in that sector. So that's why a lot of capital is chasing that. So from a yield perspective, the low yields currently are more on the logistics and residential, but most of the investors are finding those to be the sustainable ones. Offices, initially at the start of COVID, people were concerned about offices, but a lot of that concern is kind of, I wouldn't say going away, but diminishing. So yes, offices remain a question mark, but it doesn't appear to be as bad as the initial knee-jerk reaction was when COVID started. So offices will continue to also be attractive. So generally, there are opportunities in the market. What people or investors I see are struggling with is there are fewer deals in the market and a lot of capital chasing. So I think now it's more about where to park your capital, and that's why the yields are getting compressed, and as more capital is available and is chasing for real assets.
That's very interesting. Samir, let's talk about something that's a little bit closer to home. There's news around, in fact, in Dubai, the vaccine is already out to a certain extent, and you have different strains of or types of vaccine available in the market. We have seen the hospitality and the retail space do relatively well over the last few weeks because of the tourists pouring in. Do you feel that Dubai is well placed with 2021's Expo, as well as more affordable residential offerings, for it to become a more stable market? And can you talk a little bit about your view on the overall recovery of the real estate market here in Dubai?
The Dubai market seems to be holding quite well. I mean, it's been on a downturn pre-COVID for the last 4 or 5 years. So the downturn has been there. But I think people are witnessing now kind of a bottoming out, and there are certain select sectors and certain locations where kind of slightly, there is a bump up in the value. So within Dubai, people are looking at and saying the residential villa sector is doing well, better than versus the residential apartment sector, given that more people are working from home, they want the garden, they want to step out. But in terms of tourism, Dubai did very well to position itself, portray to the world that a lot of all the guidelines and regulations are in place for tourists to come and have a safe holiday. So that's reflected very well. I mean, if you would have stepped out in the last 2 3 weeks, whether you went to restaurants or any of the hubs or the roads, there was activity and traffic increase, which is a very good sign. The airports have been busy. The taxi drivers have a smile on their face. So things were slowed earlier. So yes, a lot of initiatives that the government is doing is showing results. We all recognize it's a tough time. It's uncertain. This thing has been prolonging for a very long period. But I think Dubai, I would believe, has seen a slowdown for a prolongated period. One would say we are at or near bottom. So how it would trend further from here is always difficult to predict. But there is a general consensus that we may be at or near the bottom.
I think I quite share your views on that recovery. Samir, now to more of the fun section of the podcast. What books are you reading, or what podcasts do you enjoy?
Suraj, I wouldn't say given the current market, there's fun reading or fun kind of hearing podcasts, at least for me, because a lot of my focus, I'm reading materials on economics as markets develop, how the macro is shifting, how it will turn out, what opportunities it will present, and what risks are going to come out. So it's not so much entertainment and fun, but yes, I've been reading a lot on economics, and although have had as a business school student, we go through economics, but the way the market has changed, the way the theories of economics have evolved, it's very interesting and challenging times. I recollect, having experienced the global financial crisis. At that time, I thought, wow, I probably may not get this experience again. But go fast forward 10 odd years, and you stand up again and say, this is not a similar downside as it was before. But again, we are in different challenges. So yes, it's a very interesting times if you look at it as a student and learning and gathering knowledge. So I think most of my books and readings right now is more focused on macroeconomics and its implication going forward, where the world order is today. So it's not so much light reading, depending on the different views of the economics. It could be a doomsday scenario, or it could be something, we're going to come out quite strongly out of this.
That's interesting. The last book, or the book I'm currently reading, is What It Takes by the CEO of Blackstone. I find it quite fascinating to understand his psyche and the trials and tribulations that he's gone through for the decades before becoming what he is. Samir, could you talk about, from all your years of investing, professionally and personally, talk about something that you got wrong and what you learned from it?
Nothing really comes up to mind that I would say majorly kind of went wrong, or shook me up, or something was a major setback. But I think through every phase of my career, whether the different type of companies I worked for, the different economic cycles, I learned, and a lot of people learned different things. So different times, whether it was how important a client is and how important processes and operations are, versus how important your debt equity balance and your cash flows should be, versus going to into how critical it is to do a thorough due diligence and focus on reading each and every legal agreements that govern. So I think at different stage of my career and different experiences that I've had, I've learned different things. So not been major setbacks. So the learning outcomes have not been from setbacks, but the learning outcomes have been more from the how the economic cycles have gone around, and then you come to know and learn over a period of time. So now I would say over the experience I've developed, there are 2 3 things I always keep focus on. One, I try to keep the discipline and patience in making investments, because opportunities will come. You don't need to rush for the one which is right in front of you. So that patience and discipline helps me quite a lot. And the second one is I look to a thorough due diligence, because once you've acquired an asset, real estate is a very illiquid asset class. So you have to live with it. So you want to make sure you go through, read all the agreements you have in place, all the legal documentation, so that if something comes to bite, not that you could have thought of every scenario, but at least you know what your rights and obligations are. So yes, I wouldn't say anything, kind of adverse experience that I've had, but generally through my experience, through my career, through the various experiences I've had, I've kind of learned the key factors is be patient and disciplined, and do a thorough DD when an opportunity comes your way.
That's very insightful and gives us a lot to think about. Sameer, thank you so much for taking the time.
Great, Suresh. Thank you for having me.